What is the single most important driver of the gold price right now, and what do central bank purchases of gold tell us about the price direction? Well, joining us today is Jeff Christian, managing partner of CPM Group. He is here to discuss exactly that. Jeff, welcome back to the show.
It's always a pleasure to be with you guys.
First question, let's talk about the gold standard. Now, I've heard some theories circulating from our guests about why the gold standard is still relevant today, because the dollar, according to some of these economists I've spoken to, the dollar is declining in value. The governments need a secure peg in order to stop their currencies from falling apart. That's why we need a gold standard. Can you comment on this? Are the central banks planning anything of the sort right now?
No, central banks are not interested in a gold standard. And frankly, gold standards wouldn't help any of the issues that we have now. If you look at the history of gold standards, the gold bugs and the people who like to say that we have to go back to a gold standard say that there's never been a currency regime that wasn't pegged to gold that didn't collapse. And that's true, but it's meaningless. What's meaningful is that the only currency regime system that hasn't collapsed is the present one. All previous currency regime systems have collapsed out of their own problems, structural problems, and almost all of them were gold standards. The gold standard won't work. It won't help. If you look at the history of the gold standards, economic activity was much more volatile in the 19th century under the classic gold standards, and it continued to be volatile in the 20th century under the gold standard and under the Bretton Woods system. We had numerous devaluations and all sorts of economic and financial problems under the gold standard. Gold standard, there's a nostalgia for the good old days, but those good old days never actually really existed. And a gold standard is not going to solve it. What central banks want is a movement to a multipolar international currency regime. But in order to get that, you need to have governments around the world liberalize their foreign exchange holding regulations for individuals and corporations, and you need to have greater liquidity of non-dollar currencies. 62% of central banks' foreign exchange reserves are US dollars. About 70 to 80% of private wealth, financial wealth, is denominated in dollars. The dollar is so large that for any other currency to compete with it, there would have to be hyperinflationary currency creation in other countries. So it's going to take decades to move away from the dollar's hegemony in the international currency system. And as that happens, central banks are not interested in a gold standard. So that's just a pipe dream that these guys have.
Well, let me ask you this, Jeff. Now, if the gold standard doesn't necessarily have to be pegged with the U.S. dollar, can other currencies use the gold standard? Other less developed economies, emerging markets, for example, would they benefit from a gold standard? Instead of pegging themselves to the U.S. dollar, why not just peg themselves to gold?
No, actually, it would hurt them because, and again, it depends on how you define pegging. A classic gold standard, you have a currencies of a government and you can go to them and say, I have your currency, you have gold, give me your gold, I'll give you your currencies. And if you have that kind of a convertibility to gold, then you have the risk of these smaller countries that have financial problems and don't have the exorbitant privilege that the U.S. has as the de facto reserve currency. They would have their gold reserves robbed very quickly by people who had their currencies. So a gold currency, a gold convertible standard wouldn't help them. You could peg it to gold, but that doesn't help either because you have your own problems and people would simply trade against your currency knowing that you had this fixed peg.
Mm-hmm. Okay. And Jeff, we know that central bank buying of gold has dropped off in 2020 relative to the previous year. Have you noticed any data that suggests they're picking it back up?
No, there hasn't been any real noticeable increase in gold purchases by central banks. Central banks are much more price elastic or price sensitive than investors. And as investors bought more than twice as much gold in 2020 as they had in 2019, they drove the gold price to record prices. At those record prices, central banks said, we're not going to pay those rates. When the price is $1,200 to $1,400, we'll gladly buy gold But if investors want to bid the price up to $17 or $18 or $1,900, we're not going to buy gold. In addition to that, the central banks were kind of preoccupied with the economic recession and trying to help their countries survive the pandemic and the economic recession.
We've talked about this subject, you and I, before, and what I've learned from you is that central banks are very price sensitive. And so what we've seen over the last couple of months is that the gold price has come down. Wouldn't that incentivize central banks to be stockpiling at these lower levels?
It's funny because you have these guys saying about how low the gold price is. It's not low. It's like $1,730. That's much higher than it was a year ago. And it's not record levels, but it's near record levels. So from the central bank's perspective, $1,700 is not a bargain basement price. They're, as I said, they were buying at $1,200, $1,300, $1,400 a year ago in 2019 and 2018. And the fact that the price has gotten down to 1,700 is not necessarily their threshold.
Well, should investors then, Jeff, should investors be paying attention to central bank purchase patterns in order to make forecasts on perhaps where the price is going? Because if they're not buying at current levels, perhaps they don't think it's going up anytime soon. Is that a fair assessment to make?
Well, the central banks are not active enough in the gold market to actually have the primary influence in gold prices. So gold prices will respond more to the private sector investment demand trends, buying and selling. The fact that the central banks see these prices as high tells you that the central banks are not going to get into the market, which will create some weakness and some headwinds for gold prices rising. But the real key is to pay attention to what the private sector investors are doing, buying or selling or standing aside, and what are the factors that drive those private investors to buy.
Okay, perfect segue, Jeff. Let's talk about investment demand now. You've given me this chart. Let's take a look at this chart. So the blue bars and the red line, the title of the chart is Gold Investment Demand to Remain at Historically Elevated Levels. And we're seeing, yes, in millions of ounces, it is still at elevated levels, historically speaking. Tell us about this trend and why investment demand is still high.
Well, we've seen an upward shift in the investment demand curve for gold over the last 20 years. And investors have been buying more gold for a longer period of time at higher prices than ever before, since 2002. And that, there was a little bit of weakness in 2014 to 2019. Last year, they bought twice as much gold as they had bought in 2018 and 2019 in terms of physical gold on an annual net basis. And that's going to continue. And the factors that are driving that investment demand, there's some gold fundamentals, but the primary ones are economic instability, financial instability, concerns that the stock market is looking top heavy, concerns that the dollar could fall, or that you'll have international currency volatility. So it's those economic and financial and political uncertainties that are driving investors into gold. And while things look a little bit better this year than they did in 2020, we still have massive economic, financial, and political instability. And we're still facing the pandemic with a lot of public health authorities saying that we may well wind up having a major second wave. Okay.
How important is net investment demand in predicting prices? Because I'm looking at this chart and I've noticed just by looking at it off the cuff here, it does seem to correlate quite nicely with the gold price long term, does it not?
If you do econometric modeling and you do a lot of econometric studying, what drives the gold price, the single most important factor is investment demand. And the ancillary or corollary issues, which are those exogenous variables like interest rates, inflation, economic stability, banking system stability, financial asset competing markets, and stuff like that. And those things are the main drivers of the gold price.
So what you're saying is that investment demand is driven by other variables that economists look at, like real interest rates, inflation rates, and so forth, right? Those are the variables that drive investment demand.
Right, correct.
Okay.
Yeah.
So let's talk about these variables then. Let's talk about real interest rates. Let's talk about inflation expectations. I've been getting mixed messages from our guests. I've got people on both sides of the debate. Where do you see these variables headed?
Okay, first off, we don't see inflation as a problem. Inflation hasn't really been a problem since 1982. Inflation comes from monetary policy, and the monetary policy is not necessarily inflationary, despite what people say about all of the money creation. And the other place that inflation comes from is the real economy. And there you have excess labor, excess manufacturing capacity, excess retail capacity, excess commercial real estate, all of which are deflationary, not inflationary. So we're not worried about inflation.
Okay,
right?
you're not. Well, is the Federal Reserve worried about inflation because that determines their monetary policy? What do you think?
No, the Fed's not worried about inflation. The Fed and other central banks actually keep writing about their concerns about deflation on a long-term basis. If you look at the Fed keeps talking about wanting to have 2% U.S. Consumer price inflation in the United States. They see that as a noble objective, and they keep trying to get to encourage inflation up to 2%, and they can't get there. So they don't see inflation in a problem, except insofar as they would like to see more inflation because they think that correlates with economic health. And they can't get 2% inflation, let alone the 7% or 14% that you saw in the past that really correlated to strong investment demand for gold.
Yeah, I mean, look, Jeff, you've worked through the 80s. What caused double-digit inflation back then? Why aren't we seeing the same thing today?
There were a variety of things that were occurring back then. And people don't realize that until 1979, the Fed actually targeted interest rates as opposed to inflation. So they sort of let inflation run wild. But in addition to that, you had a massive amount of deregulation. You got a highly regulated world economy and U.S. economy coming out of World War II. And that really continued through the 50s and 60s. You had the Bretton Woods dollar gold standard. And it caused a lot of economic dislocations, having fixed exchange rates and having regulations and stuff. People don't realize, if you had a plane in the past, if you were an airline, you had to get the FAA would say, these are the flights that you can take, these are the times that you can take, these are the number of seats you're going to have, and this is what you can charge. All of that deregulation started in the 70s, and you started seeing a lot of inflationary pressures that had built up since World War II come into the fore. So you had deregulation, you had the start of globalization, you had a number of economic issues. You had the dollar, which had been restrained at $35 an ounce. And when it was floated 50 years ago this August by Richard Nixon, well, it's actually floated in 68 by Lyndon Johnson, but Nixon closed the second gold window in August of 71, you
Right.
started seeing a lot of inflationary pressures. And those inflationary pressures were left unchecked until Volcker took over in the Fed. And when Volcker took over at the Fed, he said, we're going to kill inflation. And he did, by throwing us into the deepest recession in the post-war period at the time.
People talk about how monetary stimulus on today's level is going to cause hyperinflation. Well, let's just look at the 80s and late 70s. We didn't have back then they didn't even call it quantitative easing, but there wasn't huge amounts of monetary stimulus back then, right? That wasn't the cause of inflation.
Right. If you look at 1982, it was a very interesting time because the gold price had gotten to $284 an ounce. We had an international debt crisis at the depths of a double dip recession. And Volcker called central bankers from around the world to Washington. They had a meeting and they just opened the sluices and they flooded the world with money. And people saw that and they said, this has got to be hyperinflationary. And they started buying gold. And gold went from $280 in July of 1982 to $500 in December.
Sorry, who's they? You said they buying gold. Who was they?
Investors
Okay.
around the world started buying gold because they saw all of this monetary creation. But when we got into the first quarter of 1983, we were out of the recession. The international debt crisis had been resolved with the introduction of Brady bonds by the U.S. Treasury. And the Fed started selling bonds to sop up all that excess liquidity. The deficit had gone from 60 billion to $320 billion. There was plenty of need for money on the part of the U.S. Treasury. They sold bonds, they sopped up the liquidity, and the inflation never came. And in fact, inflation went from 14% to 7% to 4% to 2%, and it hasn't been rising ever since. And during this ensuing 50 years, you had 82, 87, 91, 97, 98, 2001, 2008. You've had all sorts of economic and financial crises. The Fed has repeatedly flooded the world with liquidity to get us out of those problems. And then they sop it up by selling bonds, and they preclude the inflationary implications. So people who are looking at the current monetary stimulation and accommodation and saying, this has got to be hyperinflationary, they don't know their history.
Right. Okay. So let's just get to the bottom of this now, Jeff. What we've seen in the last 2 years, well, not even 2 years, but the past 18 months, is this going to lead to hyperinflation? The massive amounts of money printing, liquidity, expansion of the money supply, M2, what's going to happen to inflation because of just that?
Yeah, we don't think it's going to be inflationary because A, the Fed has the ability to sell bonds and sop up the excess liquidity if you ever start seeing problematic inflation. You know, if you see inflation go to 2%, the Fed will be happy. If you see the inflation go to 4%, they can sell bonds and sop up that excess liquidity. But you have these deflationary pressures from the real economy, surplus labor, surplus manufacturing capacity, the fact that like the typical bank in New York City has said we need 40% as much office space coming out of the pandemic as we did before that.
Right.
So you've got a lot of deflationary pressures that will offset the inflationary implications of monetary policy. And the Fed has the capacity to sterilize the inflationary implications before they actually materialize.
That's very interesting. So what you're saying is the investment demand that we've seen, the historically elevated levels of investment demand in gold, that isn't actually driven by inflation expectations, is political risk, investment risk, and all of the other things you talked about, right? There's nothing to do with inflation per se.
Yeah, you know, we have like 6 sets of factors that we look at that drive investment demand. And the one that is least important now and has been least important for the last 30 years is inflation. You know, competing asset markets, economic stability, financial market stability, banking industry stability, political events, all of those factors have been much more important in determining investment demand over the last half century.
And I look at market indicators like the Treasury Inflation Protection Security, the TIP ETF, for example, issued by BlackRock. That's actually been trending downwards, indicating the market's been thinking inflation expectations are going down. Why are people saying gold? Why are people saying that inflation expectations are actually going up when the market is telling me it's not? Why are people saying that?
I think if you look at the mainstream, if you look at what the Fed's writing, if you look at what the Treasury's writing, if major banks and economists, they're not concerned about hyperinflation. The hyperinflation rhetoric that you're hearing are coming from people who want to believe inflation because they want to believe that gold prices are going to go to $5,000 or $10,000 an ounce.
Right. Interesting. Let's talk about one more thing here. The nominal interest rates. You have a good chart here. Nominal interest rates, a tale of two markets. On the left, you're showing U.S. bond yields since 2019. On the right, it's long-term U.S. bond yields. It's a good point you brought up on this chart. Despite recent jumps, the yields are still historically low. So my question to you, Jeff, is why is it that the gold market has been sensitive to yields rising, even though, again, historically, like you pointed out, they're still very low?
I think it's exactly what the title says, a tale of two markets. You have some investors who are shorter term and they trade off of valuation models that use U.S. Treasuries as the risk-free denominator of things. So as interest rates rise, even if they're very low and they're only rising slightly, as interest rates rise, they will mark down their expected valuation of other assets, including gold. And that's what's taken gold from $1,900 to $1,734, is that shorter term valuation driven thing, a short term market. But again, gold at 1734 is still close to historically high levels.
Yes.
And that is the other market, which is those longer term fundamentally and macroeconomically driven investors who say, yes, interest rates are rising, but they're rising at a very low pace. They're still extremely low on a nominal basis. They're still negative on a real inflation-adjusted basis. And if I look at the correlation between gold prices and interest rates, it takes 3% real interest rates for investors, longer-term investors, to say, I don't need to own gold now. I can put my money in treasuries. So those longer-term investors are saying, you might think that the price should be 1,700 instead of 1,900 because you're a short-term valuation-driven investor, and that's fine with me because I will buy at 1,700 because I'm a long-term investor, and looking at the world macroeconomically, I want to own gold.
Jeff, tying this all together now, what's your sentiment on gold for the next 12 to 18 months? Bullish, neutral, or bearish?
We think that you'll see the price tread waters, pretty much move sideways over the next 6 months, the next 2 quarters, the middle part of 2021. 1680 looks like a solid base. You could see it go a little bit lower, but we think it's sort of to move sideways to slightly higher over the summer months. And then when we get into the final 4 months of this year in 2022, we think the gold price starts rising. And then as well known, we're looking for record prices 2023, 2025. But we think that that is further down the road when these economic problems become much more problematic than they are right now.
Okay. Jeff, let's talk about these economic problems at another time. We'll follow up on what you think these major issues are. We'll have another 20-minute discussion on just that topic, I'm sure. Thank you very much for coming.
My pleasure.
And thank you for watching Kitco News. I'm David Lin.